David Zervos is Chief Market Strategist and Global Head of Fixed Income Strategy and Economics at Jefferies. He's here on the InsideTrack. So, David, why don't we begin with Ben Bernanke and the Fed's PR push? We hear so much from Bernanke himself and others about transparency at the Fed. What good is it doing?
I don't know that it's doing a lot of good, but it's certainly giving us a lot to write about and a lot to think about. The debate on transparency has been around for a long time. I'm on the fence about it. I don't know that all of this is actually that healthy. But what I would say is that we're learning a lot, and we have learned a lot about what the Federal Reserve's reaction function is, how they are going to react to crisis, how they're going to react to Europe, how they're going to react to virtually any change in the economic data around the globe is fairly acceptable now in I think all analysis that we do. 2011 was a great example where the European markets became unraveled and the Fed came in even while the ECB was sitting there sort of like a deer in the headlights, and they came in and they changed the language. They started reinvesting the mortgage proceeds back into the mortgage market. They did the twist, and finally they changed this overnight this currency swap rate, which was at OIS plus 100 to OIS plus 50. I think all that was just, the constant reaction of the Fed to basically say, we got your back. We are making this recovery happen. We're reflating.
But is the Fed or central banks in general getting too involved? I mean, you say in large, these central banks are really going through a balance sheet expansion trade. Are the markets absorbing the fact that they're really leveraging themselves here?
I think at the end of the day, they can do it. They print the money. They have the ability to lever their balance sheets. There are no shareholders in these central banks that will go, oh, my goodness, you have assets that are, too scary for your liabilities. Their liabilities are the dollar bills and the euros in our pockets. They don't have to really worry about the shareholders worrying about the leverage in their balance sheets. So they are coming in. They're taking advantage of the fact that they are the monopoly provider of liquidity, and they're doing what I think, in the end we'll look back on and say is the right thing. But we're going to have a cost from it. Look, the alternatives, there's no free lunch in all of this. We have a debt crisis both in the U.S. and in Europe. We're going to have to pay one way or the other. Either we're going to see defaults and we're going to see serious depressionary type activity, or we're going to get inflation on the back end. I think what the Fed and now slowly but surely the rest of the central banks around the world are recognizing is that the inflation on the back end is probably an easier risk to manage, and it's a sort of longer term risk to manage than it is to go through the pain of recognizing all the losses in the immediate term.
Okay, so that's the calculus at the Fed. What about yours? Do you believe that, let's just acknowledge that at some point, right, there has to be a deleveraging.
Yes.
Right, so the Fed is leveraging up. To what point, we don't know. And then eventually it's going to have to deleverage. How painful is that going to be? How difficult is it going to be for the Fed to manage that? In your note, you point out that Ben Bernanke told Diane Sawyer, yes, he has 100% confidence in the Fed's ability to extract itself from this unprecedented situation it's got itself in. How do the markets behave? How does an investor position himself ahead of that?
I think what Ben was being very careful in what he said, in that he feels comfortable that he has the tools. I think nobody's really comfortable that they can control the inflation on the back end of this. And I think he was very clear about that, and he might not have been as clear in the 60 Minutes interview, but he was much more clear in this interview. And I think that's the right answer, which is we don't know what these tools are. We've never used this. This is what I like to call the greatest monetary policy experiment of all time. And when we get out of it...
Happening now
in a theater next to you. And we're going to watch the end game unfold, and it's going to be complicated, it's going to be messy, and it's going to generate, I think, a lot of tremors inside the bond markets and other asset markets as we try to come back to reality with using the old monetary policy tools that we know and love from the last 70 or 80 years.
Do you think we will see defaults here?
We will see much less, given what the Fed and the ECB and the Bank of Japan and the Bank of England and the S&B have done in terms of their balance sheet expansions. The G7 central banks are basically cushioning the defaults by expanding their balance sheets. And what they're getting in return is a risk of all of those excess reserves and all of those liquidity adds fueling the next round of an inflationary run-up. When, how exactly that happens is very complicated to sort of forecast, but there is no doubt that all of that liquidity will have a very big impact as the economy starts to get its animal spirits going and juices flowing and everything starts to move.
David, I want to go back to your Aerosmith analogy, if I may. So Steven Tyler made that remark about Joe Perry.
Right.
Joe Perry is still playing for Aerosmith.
Absolutely.
Ben Bernanke may not be the guy, right, who ends up coming out on the other side of quantitative easing. How much of a risk is that? Has Ben Bernanke effectively forecast or laid the pavement, right, for the Fed to inevitably follow? Or is it possible that somebody else sitting in Ben Bernanke's shoes or filling his seat could go about it a different way?
I think it's very likely that someone who fills his shoes could go the other way. For example, suppose we had a Republican president. Suppose that Republican president in January 2014 nominates a new chairman of the Fed. It could be someone who gave testimony the other day, John Taylor. John Taylor has been very critical of the way the Fed's operated both in the early part of the 2000 decade as well as today. John Taylor would be a completely different Fed chairman than anything that would come from the Bernanke side of the equation, or I think a Democratic president nominee, if a Bernanke or Obama nominee, if we were to see Ben not want the job in 2014. So, you know, our analysis of what would happen in markets would be completely different in a world where John Taylor was the head of the central bank, because we'd have a completely different Federal Reserve reaction function.
David, we have to leave it there, but we would love to have you back. Thank you for joining us.
Thanks for having me.
David Zervos of Jefferies here on the Inside Track.